From our perspective, it's really hard to pick the winning technology that's going to be around in 10 years or 20 years when it comes to battery technology, for instance. But one thing that will still be the same in 20 years is a lot of these physical properties for these different metals.
So in episode 15 today, we're going to be talking about commodities. A lot of people know gold, they know silver, perhaps they know cattle, perhaps they know coffee, but commodities can be a meaningful part of a portfolio and a further diversification to stocks and bonds. Because of that, today, David's going to be with us talking about commodities, how they fit into a portfolio, what they do in respect to how they correlate to the broad markets, as well as answering some questions about what we think about commodities, a little bit of Q&A, and a little bit of pushback of where commodities may or may not work. Welcome back, everyone, to episode 15 of the J&J Show. I'm Josh Yoskosky.
I'm Joe Simon.
And as we have in the past, we have another guest today. But without any further ado, I'll hand it over to our interviewer.
I'd like to introduce David Waugh with Neuberger. He's an associate portfolio manager working in the commodity space. David, why don't you tell us a little bit about what you do and kind of how you got into commodities?
Oh yeah, well, thanks for having me, guys. Commodities, interesting asset class, so a little bit more niche, I would say. But yeah, beyond like stocks and bonds, I guess, what's the best there to round off the picture? Well, we really like commodities. It's sort of the third asset class, I guess, that we think of here.
Let me jump in there. Like a lot of our clients may not know. Can you explain, I think, what a commodity is actually?
Yeah, sure. Most of our clients, it'll be, I like oil when it's up, not when it's down. I talk about gold. I talk about silver, occasionally palladium if people are stealing catalytic converters. But outside of that, those are really the three that we hear about.
Yeah. So this is a good question. And, you're thinking of like stocks and bonds most of the time, right? And so where commodities really come in, like what's helpful about commodities and where we start hearing more about them is when we start to see inflation picking up. So when people are talking about inflation, right, they're seeing prices going up at the grocery store, for instance. So you're looking at things like, meat prices, you're looking at like sugar, everything else, coffee, chocolate bars. So all these commodities, right, out there. But yeah, within our fund and what we look to trade, we're trading 50 different commodities across lots of different asset classes. So this will be things like, oil, you hear more about gold, copper, all the way down to, chocolate, sugar,
I assume coffee. There's all that stuff. Okay. It makes the world go around. Got it.
So when we look at our portfolios, with our clients, again, mostly stocks and bonds, why do they want to own commodities and how does that fit into their portfolio or how should it fit into their portfolio?
Yeah. So the story about this is mostly a story about inflation. So then you end up with this sort of worst case scenario, which is when growth is down, but inflation is up at the same time. So these sort of tail scenarios, it's like a stagflationary environment, right? But most recently, like what we saw in 2022, right? So bonds are down in 2022, stocks are down in 2022. So where do you hide out in periods like this? You hide out in commodities, as commodities will be doing well when you see these types of dynamics generally, historically.
Thinking about our clients, how would you own gold? Would you suggest our clients go out and buy gold bars and silver bars or, own the commodity a different way?
When I have an expanded question to that based off Joe's question is, commodities are very much a global area of the market. I don't think it would be fair to categorize them as domestic or international. They're indeed global. And they have a different group of sensitivities about geopolitical events, etc. So going off of that, should we or should an investor, piggyback to Joe's question, be looking at commodities as a strategic allocation of their portfolio, or is it a tactical opportunity, more of a short-term play for them?
Yeah. So starting with the sort of way you get exposure, I guess, the preferred way. So you look at something like gold. And so gold is, I'd say, maybe one of the exceptions in the sense that you can buy a fairly large amount of gold in dollar terms and store it in a fairly small space. It's relatively easy to buy gold bars and put them in a safe. But you think about any of these other commodities, like it could be like beef, right? So maybe you're interested in buying beef and storing it in your freezer, right?
Heads of cattle.
Or or buying cows, heads of cattle and keeping it out, at a ranch somewhere. but a lot of these commodities are a lot harder to store in the long term. So for these in general, for commodities, we like to approach them through these types of futures contracts. Just find it's a lot easier to gain exposure there, and you can get more pure play exposure to a lot of commodities. Think of coffee, for instance. Right? So everybody drinks coffee, but there's not really a good way to get pure play exposure to coffee growers. So you could buy like Starbucks, for instance, but Starbucks is going to be also exposed to coffee prices if they have to buy coffee prices at higher prices from somebody else. So if you want that pure play sort of coffee exposure, the easiest way to get exposure is through futures.
Okay. So you just mentioned a bunch of different commodities. We talked
Yeah.
about,
Yeah.
beef, water, gold. What is as far as looking at the overall market today, looking at opportunities, within the commodities market, what are you buying today? What are you looking at? Where do you think there's opportunity?
Yeah, so this is a good question, and we do get this a lot. There's lots of commodities out there. There's lots of compelling narratives, I guess, in terms of what's the next big buy, where to stay ahead of the curve. So one, I would say, long term narrative that we're seeing right now is sort of a secular trend. We like industrial metals a lot right now. So thinking of things like copper, right? I'll say when we're thinking of new energy sources that are out there, like all these sustainable energy, green energy, right?
Yeah.
Renewable energy, right? So in a way, copper is the new oil here. And so we're thinking of things like wind farms. We're thinking of things like solar panels, nuclear power plants, hydroelectricity. So all of this requires a lot of metals to build out. We need increased grids and everything to build these things. And I want to say that we're not really seeing this, I would say, as like a climate change story. So we're seeing this more as an energy self-sufficiency story, or like an energy security story.
And to kind of piggyback on that, right? So you talked about, energy and dependence on commodities. Everybody's talking about AI today, right? And one of the things that we did in our portfolios last year is we wanted exposure to AI, but we didn't want to own the AI directly. So we kind of went out and bought the companies that benefits from the build out of AI.
Infrastructure, if you will.
Yep. Nice. So I got to imagine there's some sort of commodities play there that's kind of attached to that build out of AI.
Well, there might be newer sides to it. For example, something that comes to mind is lithium when it comes to batteries. Something that for a period of time, more so during COVID and the onset of Tesla, talking about batteries and battery life with lithium. So does that continue? Are these trends how quickly do trends cycle in the commodities space, I guess is my underlying question.
Yeah. So that's a very good question. And thinking about AI more generally, it's coming back to your question. So then, yeah, of course, so, we see a lot of this build out as well for AI, data centers, increased grid, and of course, like all the power demand that's going to come from all these data centers. So that just massively, commodity intensive in terms of demand for commodities. And a lot of these commodities will be things like copper, again, to build out your data centers. And, it just takes time to open new copper mines, right? We're talking like years and years to develop a copper mine. So the supply is a lot more constrained. And so when the demand picks up, and then, the demand will pay anything, that all these AI companies can pay whatever they want to build these data centers. But at the end of the day, you need the physical copper to build the data centers.
Yeah. What are your feelings on like rare earth elements? I know obviously everything going on in Iran, they're using up weapons and weapon systems right now. And I think rare earth elements kind of falls into that, the build out of that stock. Do you see opportunity there going forward, or?
Yeah. So for rare earths in general, what our thoughts are there. So rare earths, this will be metals that sometimes aren't that rare, but it's just that a lot of the refining capacity is in China. And we're talking like 95% of global refining capacity will be in China. So for some of these metals, it's less a question of rarity and more a question of wanting to develop that refining capacity. And we definitely see an overall trend, I would say, towards call it like deglobalization, like a bit of a reversal in terms of how globalized the world is. So just trade barriers, like coming back to regionalization, friendshoring, nearshoring, like whatever buzzword you want to use. And yeah, just bringing a lot more of that production back home, and that is definitely commodity intensive. Also, you have to do this whole build out to bring this refining capacity back home. So rare earths, I think, is the extreme one here in terms of where the capacity is. I do want to talk about your question also, because the lithium question is quite interesting, and we do get these types of questions also. when it comes to what's the future going to bring in terms of what's the best way to build a new battery, right? So that's because that's kind of what the lithium question was about, I
Yeah,
think.
subset of it, certainly.
So a lot of tech was being developed, especially around COVID, like these new batteries and battery architecture, right? And so from our perspective, it's really hard to pick the winning technology that's going to be around in 10 years or 20 years when it comes to battery technology, for instance. But one thing that will still be the same in 20 years is a lot of these physical properties for these different metals. And so you look at metals like aluminum, for instance, are going to continue to be very lightweight, and metals like copper are going to continue to be very good conductors.
Yeah.
So at the end of the day, you know that no matter what the exact battery mix is that is going to win out, you know that you're going to need copper as a conductor. You know you're going to need aluminum for anything that's sort of lightweight production, and so some of these properties aren't going to change, and that's what we like to bet on.
And this is a separate question I had for you, so I kind of appreciate the bifurcation. Is there's commodities, and then there are, for example, what I used to hear a lot about are gold miners or silver
Right.
miners, as opposed to the mineral itself. So where do, at least in your professional opinion, where do the miners fall as opposed to the commodity itself? Should we view them similarly, or are they adjacent, or how do they kind of all come together?
Yeah. So that's a good question, which comes down to what's the best way to get exposure to some of these commodities. And so you look at companies like gold miners, for instance, versus just buying gold outright. So we generally prefer a more pure play exposure to these different commodities. So like buying gold futures as opposed to buying gold miners.
Yep.
And the reason for this is that, with gold miners, sometimes you just end up buying gold miners that are just bad operators, right? And so then they just lose a lot of money.
Money level risk.
Cause I watched
Yeah.
Gold Rush. I mean, you guys don't make it, right?
Yeah,
Yeah, that's
not
right.
always.
Yeah.
So coming back to maybe why people buy gold or why people buy, some of these commodities is going to be you are looking for that sort of protection against inflation, right? And if you're buying a gold miner, these gold miners are going to be facing the same sort of inflationary input costs that everybody else is facing. So like labor costs are up, their material costs are up. So at the end of the day, even if inflation is going up and that's great for gold, it might be bad for the gold miners also.
It's funny because a lot of times when a client calls us to talk about buying gold, it's not even inflation they're worried about. They're talking about the end of the world, right?
Yeah, yeah.
Everything's gonna crash. The market's gonna crash. Talking about gold a lot.
Out of the other 49 things.
Yeah, at least I got this gold
Yes.
I can trade for something. What are your thoughts around that? Like, I mean,
If that's someone's
If-
motivation, you mean if someone's
Yeah.
motivation is, oh, if the world ends, I have gold.
Yeah.
I'm assuming, not to put words in your mouth, that is not one of the discussion points.
No. That's generally not a discussion point, I would say. But I would also say that not moving quite that far, but we do see a sort of trend towards moving away from the US dollar, like globally. So, like a de-dollarization sort of trend. We see this central banks around the world, especially after the Russian central bank had its assets frozen after the beginning of the war in Ukraine. So just a lot of these central banks around the world now realize they maybe want to reduce their exposure to the dollar, and they're going to be buying gold instead. So even if this is not the world is ending, there still is like a trend towards.
From where I'm sitting, also, not to be provocative, but it also does strike me, going back to a question from eons ago, that there's very much a tactical place for commodities, not necessarily I'm going to buy this and hold it in perpetuity, regardless of market and circumstance. There is a very tactical opportunity to commodities.
Yeah. We do see tactical opportunities in commodities, but I would also nonetheless argue for a strategic allocation. And the reason I argue for a strategic allocation is sort of coming back to the idea of what happens when your stock and bond portfolio is doing badly. So obviously your stocks and bonds are going to be the largest part.
Correlation.
Yeah, it's your largest part of the portfolio. Sometimes the correlations come together, and you had years where they both come down at the same time. So like 2022, right? But also more extreme would be like the 1970s, where we had really inflation picking up, and then you had the stagflationary environment that was just really bad for stocks and bonds at the same time. And those are going to be periods where commodities do well. So this is really like an insurance in a way.
That's fair.
So you're just buying a small allocation here, putting a little bit of money to work here,
So when you say small allocation, what are your overall thoughts? Is it 5%, 7%, 10% in
Knowing
portfolio?
that this advice does not
Yeah,
fit all investors.
it does not.
Boilerplate disclaimer, talk to your financial advisor, doesn't fit everyone.
But outside your
Yeah.
exactly.
Yeah. I mean, we don't obviously, advocate for a particular allocation. I'll say we do run some, portfolios.
Or do you have a
stocks.
range?
And I mean, we might be in the 5%
Okay.
range. We're not talking like a huge allocation here,
Yeah.
but it definitely can help out. So one thing we're monitoring right now is this trend called El Nino, right? So this is a weather pattern in the Pacific. So the Pacific Ocean is really big. And so even just small changes in the temperature of parts of the Pacific can have global impacts on, climate, weather across the globe. It looks like we're shaping up to have an unusually warm El Nino pattern,
Yep.
which then translates into droughts in part of the world, floods in other parts of the world, temperature extremes in different areas. And so then, of course, this has downstream impacts on agricultural commodities in particular.
Sure.
So some of the commodities that we see most affected by these types of weather patterns are going to be commodities like cocoa, like chocolate, right?
Okay.
So if you look at where cocoa beans are produced, right, a lot of it, we're talking like 70% of the market comes from West Africa.
I got to know what you're talking about. I'm a coffee guy.
All
Is
right.
it going to affect my coffee?
So coffee is another good one. So good question. You probably drink the Arabica.
I do. I
Variant.
do a lot of it, yeah.
So Arabica is definitely the better one. The cheaper version is the Robusta variant. So Arabica, a lot of it comes from Brazil.
Yep.
Robusta, a lot more of it comes from Asia. So this is going to be like Vietnam or like Indonesia. And so the Robusta crop, so we trade both of these actually.
Yep.
The Robusta crop is the one that looks like it's going to be a little bit worse off from El Nino. So it looks like we'll have drought patterns over there.
Sounds good. You're
That-
saying.
Arabica should be good.
All right, perfect.
But I would think in some areas of the world, just by nature of the area, there could potentially be some level of manipulation of where basically supply and demand, restricting supply, for example, to inflate the prices. But I assume that's just a known, no pun intended, commodity.
Yeah.
When working with commodities, there's going to be some of that.
Yeah, I mean, the biggest example is OPEC, right? So OPEC definitely controls the amount of oil they produce, and they attempt to control the market. At the end of the day, they can control some of this, but these are physical commodities. So you do need to, get this physical commodity in hand and burn it or use it however you need to use it. So yeah, you can only hide the reality for so long, I guess.
So I think at this point we've covered a lot, right? So what I do want to just kind of put out is there any one, last statement you want to talk about, or last thing you want to say about commodities and kind of how it should fit into our lives and our portfolio, and
How your average investor should think about it.
Yeah. Well, really, I think the base idea behind commodities is we like a little bit of commodity exposure because it helps protect during these inflation surprises. So you have like a sudden spike in inflation that's caused by like a new war somewhere, right? So that's where commodities are gonna help out and just help offset, what's going on with stocks and bonds, which don't like inflation as much. So that's why we like commodities, and that's why we include them in our asset allocation.
That's perfect. And that's something we have been cognizant of the last few years is inflation, right? So perfect. Well, with that, we want to thank you for your time today. We
Absolutely.
appreciate you joining us.
Coming out to visit in studio.
Yeah. So we're gonna wrap up episode
15.
15 of the J&J Show. I'm Joe.
I'm Josh.
Like,
Comment.
subscribe. We'll catch you guys next time.